I don't know about you, but I love getting paid twice. Premiums and dividend checks. That's why I love running the wheel strategy on dividend paying stocks. For example, Pepsi right now is getting absolutely hammered. It down on towards its bottom Bollinger Band and well below its 2 and 300 day moving averages of 168 and 158. For me, this is a fantastic setup for cash secured puts. Let me show you what I'm talking about. I'm going to head over to Pepsi here, and I'm going to select trade Pepsi options. I'm going to click sell a put, and I'm going to put that expiration, pun intended, to 36 days. Basically, what I'm saying here is I'm willing to buy 100 shares of Pepsi in 36 days from now at a price I choose, and I get paid a premium up front. So I'm going to take a look at a strike price, a share price that I'd be willing to own Pepsi at. So I'm looking at these 130s right here, and you can see I collect about $213 of premium from an options buyer. On the other end, hit the juice button, right? What that looks like as far as our premium return, and obviously these are at the time I'm recording these premiums always are changing with the market, right? So 213 we're collecting. Now we have to put up money because your broker isn't just going to say, hey, yeah, he's willing to buy 100 shares, but you don't have the money to back it up. So I would need $13,000 in my brokerage account or on margin, whatever is your strategy for that. You would see in about that 30-day period, I'm collecting about a 1.64% return on my collateral, okay? Now, a few things can happen, right? Obviously, in 36 days, if Pepsi hits 130, I will have to buy those shares at 130. Even if it drops to 120, I would have to buy those shares, right? But if it stays above 130, my contract would expire. My collateral would be freed up for me to run the play again. But if I do get assigned, it's not a big deal because then we can sell a call. Now, what the call actually is we're saying, hey, we're willing to sell our 100 shares of Pepsi at a price that we choose on a date that we choose and get premium income collected up front. It's awesome, baby, right? So let's say we bought them at like 130, and now we want to sell it at 135, 36 days later. Again, all these numbers are going to look different for you. All these numbers are constantly changing, right? So let's say you want to sell it at 135, right? Because we buy low, sell high, right? And you collect $360 from an options buyer for that. Now, a few things can happen. Obviously, if it hits 135 or 140, you're going to sell your shares at 135, right? Or if it stays below 135, the contract will expire worthless. You'll get your 100 shares back to run the play again. If you want to learn more about this strategy, make sure to head over to the link in bio. I have a 30-minute class that shows you exactly how you can start potentially collecting some juicy income from an options selling portfolio. And of course, hit that like button, that notification bell down below, and drop any questions that you have down below in the comments.